Hi, this is your Mortgage Rate Watch for Tuesday, November the 30th, and I'm Keith Akata with the Mortgage Reel. So, a couple of the key things that we want to point out today. We've been talking about how the financial system in Europe is continuing to ail with the euro and what's going on with Portugal, potentially Italy and Spain. All these countries are starting to come out and facing the same impacts that the United States has been basically open booked about with the world for the last 24 months, almost 36 months. So going back in past performance of the bond market and mortgages and mortgage-backed securities, you go back to 2009, Greece came out, they said they needed a huge influx of money to sustain their financial systems, and what had happened in turn is it showed that the U.S. bond market was a safe haven, and when that happens, the bond market and mortgage-backed securities are the beneficiaries of that, so it pushes the yields lower. In turn, for homeowners out there listening, that the interest rates move lower. Now, key thing to keep in mind is, right now, yes, the U.S. bond market is the beneficiary of this, and it's pressuring yields to move lower, but at the same time, once they do in the sometime future shore up their systems and they do start to show that they're improving, these mortgage and mortgage-backed securities, the bonds, the yields, everything will be pressured higher just because that money will be exiting our system going back overseas. And when it does that, inevitably, we could have a sharp spike in interest rates. That is one concern. The other side that's playing against it, yes, we are having this huge influx, which is a benefit, obviously, because rates are coming down. But on the other side of that, every time we have economic data reports that are coming out, it is showing that the U.S. is on some type of path of recovery, and that all of a sudden takes out some of the steam of this money coming in. So the rates right now have found what we call a level of support, at least it seems. But there's also a lot of what they call ceilings, and what that means is before interest rates can move lower, we're going to have these barriers to break, and we're going to have consistency in order to break those barriers. And at this time, there's not a lot of information nor data coming out that could show that we're going to be pressured lower. So key thing again is taking advantage of timing. If you would have been in the same situation a week and a half ago, you're probably pulling your hair out because rates were just seemed like they were going to move up to 4.5, maybe 4.625. We've seen the easing now, definitely an opportunity to take advantage of it. The other key thing, the last point to keep in mind is right now on the media, on CNBC, they're showing President Obama speaking about the middle class tax hikes that from the Bush administration that they were getting ready to expire. It sounds like now the Democrats are having a change of tune. So the one quote is saying it would be disastrous right now if they would let these expire instead of letting them extend. So that's also going to be taken as a positive for our economy. So it is one thing because taxes have so much influence on the way that our country and people here spend in consumer confidence. If they have higher taxes, obviously, then people cut back on spending. And if we know right now, if we have a cutback on spending, the U.S. is going to probably fall into maybe another recession. So the spending is obviously something that we have to keep going in our country because that's the one thing fueling us. Make sure to follow us on our Twitter page for any additional breaking news posts, and we'll definitely be back tomorrow with more information and news as far as what's going on with the European countries and how that's affecting your home mortgage. Talk to you soon.